Welcome to the Deep Dive, where we break down the big, complex questions facing you today and really try to give you the actionable knowledge you need to move forward. And our subject today, it sounds a little like science fiction, but it's quickly becoming a core reality for retirement planning, the 40-year retirement.
It's a longevity revolution, really, and the implications are just massive. If you retire at 65, living healthily, actively until 105 is, well, it's no longer just a possibility.
It's a real probability.
It's a tangible probability for a big and growing part of the population. And this just forces us to throw out the old playbook. A plan that was designed to fund, a 20-year retirement simply cannot handle the stress of 4 decades.
Right. And the research we've pulled together for this deep dive, it reveals a core problem. Most people are, frankly, catastrophically unprepared for this.
That's the sobering reality.
Yeah.
The source material shows that when you look at early retirees, only 46% had a formal written plan.
Less than half.
And here's the kicker. Even for many of those who did have a plan, they still experienced pretty substantial financial stress soon after leaving work. So there's this huge gap between the theory and the real-world execution.
That statistic is a flashing red warning light. So our mission today is to guide you through the 7 critical planning mistakes that over a 40-year period don't just happen once. They compound, they snowball.
And they can transform a manageable retirement into a really stressful one.
Exactly. So let's unpack the foundation first, starting with the biggest structural failure.
Okay, let's look at the bedrock, or I guess the lack of one. The first major error is this foundational failure, operating without a formal written retirement plan.
It sounds so obvious, but I think people conflate having a 401k balance with having an actual plan. And that's just a savings account, right? Not a strategy.
Precisely. The analogy our sources use is perfect.
Yeah.
You wouldn't take a cross-country trip without a map, without an itinerary. Yet people are embarking on a 40-year financial journey with just these vague intentions.
Right.
A formal plan has to be comprehensive. It's got to cover your projected expenses, your income sources, tax strategies, healthcare costs, legacy goals, all of it.
And it's the detail that really matters, isn't it? It can't just be one big number you're aiming for. So what are the key checkpoints the plan needs to include?
It needs specific, measurable benchmarks. So if you're retiring in 15 years, the plan should have savings milestones every 5 years. It needs to have flexibility built in for tax law changes, for market downturns.
Yeah.
Without that roadmap, you are just completely vulnerable.
You'll make panic-driven decisions.
Exactly. When the market inevitably turns sour, which it will, multiple times over 4 decades, you'll panic.
Okay, so that lack of planning often spills right into the second common failure. This one's more behavioral, and it happens right out of the gate. Overspending during the retirement honeymoon phase.
Ah, yes. The euphoric celebration. You've worked for 30, 40 years. You feel like you deserve that big trip, the renovated kitchen, the huge RV.
And you do. You should celebrate.
You should. But the mistake is making those early celebratory expenses the new normal, the new baseline.
Because if you set up this high-cost lifestyle in year 1, it is psychologically and practically devastating to have to scale back in year 5 when the portfolio takes a hit. The spending habit just sticks.
It's the definition of lifestyle creep, but in reverse. You spend a ton on travel or big purchases in years 1 and 2, and those choices set a higher spending requirement for the next 38 years. You front-loaded all the fun and basically compromised your long-term security.
So what's the practical defense against that trap? How do you celebrate your freedom without, sabotaging yourself financially?
You have to segment your money. You separate the celebratory fun from what's required for sustainability. So you create a dedicated, non-renewable honeymoon fund. That's for the splurges.
A one-time thing.
Exactly. But
Yeah.
parallel to that, you have to rigorously stick to your ongoing expense budget, the one designed to last until you're 105. That way, you get the celebration, but it doesn't inflate your permanent cost of living.
That makes perfect sense. Keep that baseline low. Okay, let's move into the really high-stakes territory now decisions with huge mathematical impacts across 4 decades. We have to start with one of the most consequential choices you will ever make: claiming Social Security benefits prematurely.
This is so often an emotional decision. People want that immediate cash flow, but the long-term cost is astronomical, especially on a 40-year timeline. Claiming early permanently reduces a guaranteed income stream.
And that reduction just compounds into a huge loss of security. Let's get really granular on the numbers here because this is where the permanent damage is done.
Okay, let's use the data. If you're full retirement age, your FRA is 67, that's when you get 100% of your benefit. If you claim at the earliest age, 62, you only get about 70% of that.
Only 70%.
And that 30% reduction is locked in for the rest of your life.
Wow. And what about if you delay?
If you delay until age 70, which is the maximum, the government gives you delayed retirement credits. This increases your monthly payment by roughly 8% per year past your FRA. So by waiting, you can push your monthly payout to around 124% of your full benefit.
That is a massive spread. So let's say your full benefit is $2,000 a month. Claiming at 62 gets you $1,400. But claiming at 70, that's $2,640.
Right.
That's a $1,240 difference every single month, guaranteed, for life.
It's a critical difference. Over a 40-year retirement, that one decision can mean hundreds of thousands of dollars in total lifetime income. When you're aiming for 105, maximizing every source of guaranteed income is just paramount.
But waiting until 70 means bridging that income gap for 5 years, from 65 to 70. How realistic is that for most people?
Well, it requires strategic planning. This is why that formal plan is so crucial. Usually, you'd break that gap by drawing a slightly higher withdrawal rate from your investment portfolio for those 5 years.
So you're trading a little more portfolio risk up front?
For a much higher guaranteed income later. The trade-off is often worth it, because once you hit 70, your portfolio withdrawal rate can drop dramatically, and that bigger Social Security benefit provides inflation protection and stability for the next 35 years.
That's a great way to reframe it. It's a long-term investment decision, not an immediate cash flow problem. Okay, let's pivot to the largest, most unpredictable, and often financially devastating expense.
Neglecting healthcare and long-term care planning.
This is the shockwave. This is what derails even well-funded plans. The statistic is staggering. The average couple retiring today can expect to spend over $300,000 on healthcare costs.
And that's just routine stuff.
That's just routine medications, premiums, copays.
Duh.
And that's before you even get to specialized long-term care.
Wow. $300,000. That has to be factored into your annual withdrawal rate, or it'll just drain your investments.
Must. But the long-term care angle, that introduces a risk that's almost impossible to budget for in a straight line. The probability that you'll need some form of long-term care in your lifetime is over 70%. And those costs are not minor.
Not at all. Far from it. Depending on the level of care where you live, you're looking at $4,000 to $8,000 a month.
A month.
So if you have an unexpected 5-year stay, you could wipe out a huge portion of a multi-million-dollar nest egg.
So besides insurance, what are some actionable steps someone could take right now?
First, you have to incorporate realistic healthcare projections into that initial financial plan. Second, if you are still working, you need to maximize a health savings account, an HSA. You mentioned the triple tax advantage earlier. Let's just unpack that for everyone.
Please do.
Okay. The 3 advantages are: 1, your contributions are tax deductible; 2, the money grows tax-free, like in an IRA; and 3, withdrawals are completely tax-free, as long as they're used for qualified medical expenses in retirement. It's one of the most powerful savings tools there is for this specific cost.
That's incredibly valuable. Okay, moving into our next set of mistakes, we're looking at immediate cash flow killers and the emotional pitfalls of this big transition. Let's start with the drain on resources, carrying high-interest debt into retirement.
This is like failing to complete the task before you cross the finish line. When you retire, your income is fixed, or maybe even declining. That means every dollar spent on debt service hurts way more than it did during your peak earning years.
You're literally paying someone else for the privilege of having less freedom.
Exactly. Let's do the simple math. If you go into retirement with just a $10,000 credit card balance at, say, an 18% interest rate.
Which is pretty standard these days.
It is. You're spending $1,800 a year just to cover the interest. You're not even touching the principal. Over 40 years, that small debt becomes a financial hemorrhage. The first priority has to be aggressively eliminating all high-interest debt before that last paycheck.
Okay, so once the finances are hopefully cleaned up, we see people fall into a different kind of trap. This one is more about the emotional side of this huge life change, making dramatic, irreversible lifestyle changes too quickly.
This is where the money and the psychology really overlap. Retirement is exciting, and that newfound freedom can lead to this flurry of hasty, irreversible decisions. The common ones are immediately selling the family home, moving to a totally different state, or just making huge changes to living arrangements all at once.
And why is rushing that process so risky?
Because retirement is already one of the most stressful life transitions you can go through. You've lost your daily structure, often a core part of your identity. If you then pile on the massive logistical stress of moving, changing social circles, finding new doctors, you just compound the adjustment challenges.
Which can lead to regret and unforeseen costs.
Exactly. So the proven approach is a cooling off period. The experts we looked at recommend giving yourself at least 1 full year to adjust before making any permanent, high-impact changes.
So like rent before you buy.
Absolutely. If you're planning to move to Florida, rent there for 6 to 12 months, test the neighborhood, test the climate in July, see if the community is really a good fit before you commit to buying and, burn the bridges behind you.
Time, in this case, is really your ally. Okay, that brings us to our final structural mistake, the one that guarantees eventual failure in a 40-year plan. Failing to review and adjust your plan regularly.
This is the set it and forget it delusion, and it is lethal over a multi-decade timeline. Retirement planning is not a one-time event. It's an ongoing process. A 40-year retirement will see multiple housing crises, stock market crashes, major tax code changes.
And huge changes in your own personal health and family needs.
Of course. If you set a plan in 2005 based on the world then, and you haven't looked at it since, you're planning with completely irrelevant data.
So what has to be on that annual review checklist?
You absolutely have to review your portfolio performance against your targets. You need to do a deep dive on your spending patterns versus your budget. A sustainability check on your withdrawal rate, especially with inflation.
And your asset allocation.
Your asset allocation, yes. Are you still aligned for the next 30 or 40 years? And finally, you have to aggressively look for new tax planning opportunities every single year. You just can't afford to hope the original blueprint holds up until you're 105.
That covers the 7 critical mistakes. But beyond just avoiding things, what are the essential factors for success that the sources really emphasize? What separates the prepared from the perpetually stressed?
2 things really stand out as pillars for success. First is emergency reserves. You have to maintain 6 to 12 months of living expenses in cash or cash equivalents. This is your buffer.
So you don't have to sell when the market is down.
Exactly. When the car breaks down or the roof needs replacing, you don't have to sell a growth asset at the worst possible time. That's how you protect your growth engine.
And speaking of that growth engine, the second factor, it kind of flies in the face of conventional retirement wisdom, doesn't it?
It really does. It's the need for smart investment allocation. Conventional wisdom says you get super conservative, move everything to bonds and cash as soon as you retire. But on a 40-year timeline, becoming too conservative too early is a fatal mistake. You will lose the battle against inflation.
Because inflation just eats away at your purchasing power year after year.
Precisely. To maintain your lifestyle for 4 decades, you have to keep a growth-oriented portion of your portfolio well into retirement. You need a structure that gives you income from bonds and short-term holdings, but also maintains that equity exposure for long-term growth to fight the corrosive effects of inflation.
That gives you the balance to deal with the sequence of returns risk early on while still aiming for growth later. This has been an incredibly insightful deep dive.
We've broken down the 7 pitfalls, from failing to plan and overspending to those huge errors on Social Security and healthcare, and finally, just making sure you keep the plan updated.
So the call to action is clear and it's urgent. Look at your current plan against these 7 mistakes today. Time is your most valuable asset. Whether you're 45 and planning or 65 and just entering this horizon, the sooner you fix these things, the more time your strategy has to work.
And here's the final provocative thought to leave you with as you think about this 40-year reality. We spend so much time worrying about the risk of losing money in the market in retirement, the volatility. But if you truly face 4 decades of retirement, ask yourself, how much growth is required just to maintain your purchasing power and fight inflation? And what is the real risk of being overly cautious? The failure to grow might be a greater risk than the failure of the market, something to mull over as you build your roadmap to 105.